Hello everyone, welcome to Zerodha Varsity videos. In this video, we're gonna talk about a very interesting and an important topic, which is about investing in international equities. I'm gonna divide this video into 5 segments. The first is why and how much to allocate to international equities. Second, when we talk about international equities, how much to invest beyond US markets. Third, the products and the routes available to invest in international equities. Fourth, the currency risks that come with international investing. And the fifth, all the procedural aspects, including tax, inheritance tax, etc., that you need to know when you go global. To answer all these questions, we have with us Mr. Lovai Navlakhi, the CEO of International Money Matters, a SEBI-registered investment advisor. Lovai, thank you so much for joining us today. This is a very important topic. So many people are, searching about this. And I want to start with a very important question on why. Why international investing and how much to allocate before we go into the, further topics?
Yeah, so there are various ways to consider this. So from an individual investor standpoint, I think the one part that they need to look at is what are their financial goals. And out of those goals, are there any goals which are connected with foreign currency? It could be travel, it could be a child going for studies abroad or themselves going for studies abroad, or deciding that some family member is there, they need to keep, making trips over there. So it could be variety of things. So that's one part, which is the goals aspect. The other is, I think, from a financial planning standpoint, unfortunately, the starting point for most people on financial planning is how much equity, how much debt. So you tend to have this very strong local country bias and say everything that I will do in my country because I know about it and I hear always the information, chatter, noise, whatever you want to say about how good it is. So every country, frankly, has this home bias. So investors in those countries tend to think, oh, this is the world. So I think when you think about financial planning really from a zoomed out basis, you need to consider how much allocation you have in which country, then which currency, then maybe go into physical versus financial. And then in the financial piece, you come into debt, equity, and so on and so forth. But I think from that standpoint, I think it's very important to consider that in case there is a risk to the country, all assets will fall, irrespective of how optimistic or how bullish the views are. So let's say there's a border trouble in any country, all stocks or all values of investments will fall, whether it is property, whether it is financial assets, whether it's not only equity but even debt. Interest rates will rise because there's uncertainty there. So from that standpoint, it's very important to have a hedge. I think these are big reasons to consider international.
So even if I don't have any financial goal that is to be redeemed in the US currency or any other global currency, I should maintain some international allocation. Again, from a diversification point of view also, like having a portfolio perspective, what is the minimum allocation that we should have to international equities so that there is some level of protection, at least from the current, specific country risk or the currency risk? How much should we allocate to international equities from the perspective of diversification?
I think anything that you allocate, obviously you want to have a meaningful allocation. Because if you have something really small, whether that investment does very well or does terribly, there is zero or very little impact on your investment. Now, I think the purpose of that investing needs to be very clear. If the purpose is diversification and I just want to hedge, then I can't keep comparing and say, okay, how did my investment in that particular investment do versus the investments I was used to? And if I look at very short-term periods, obviously there'll be periods where one of the two would have done better. And there is this confirmation bias. I want to prove that what I was doing was fine. My investment advisor really forced me to do this international investing. See how it's done so badly. So I don't think the measuring of, who's in the lead at what point in time is important. The hedge becomes important.
Right.
The second thing on the amounts, I think if I wear a financial planning hat, at the end of the day, your cash flow is the most important thing you need to protect. So anything that you need in the short run from all your assets and looking at your goals, those need to be in assets which are with very low risk and also need to be in the currency in which I need that expenditure. So I can't say, oh, let me go and invest in an international fund because 2 months later I have to pay some EMI. And hopefully the currency will give me an appreciation. No, you don't do that because you're taking a risk there. So if you remove your cash flow need and then look at the rest of your portfolio, I think that's one important thing that every investor should do.
Like, what is the time horizon for the short term?
Shorter term, I would think that anywhere between maybe 6 months to the next 24 months, depending again on, am I earning, am I younger, am I older, there's no income available for me, that sort of. Now beyond that, then one looks at goals, looks at risk profile, then say, okay, I should allocate. We would think that a 10-15% allocation is good, meaningful, but it doesn't mean that today now I took out my cash flow need and I have now 3% available as excess. No, let me wait for it to accumulate to 10 and then I will invest. No, I would not suggest that. I would think you start with a smaller allocation because anything new that you get into, other than investors who like to experiment with something new first, everybody else wants to try with small sort of dips. I dip my toe in the water, then I will put my feet in, then I will go and swim, right? So it is that. So I think you should start with whatever is available for you. And of course, you have to match then a product which is available, suitable with the minimum amounts and then see whether it's possible, not possible.
Understand. Just last one question in this segment. Say suppose there are parents who don't know whether they want to send their child abroad or not because it's about 15 years, like 10 years ahead. They don't even know whether the child would want to go abroad or not. In that scenario, do you think allocation to foreign equities still matter? And at least from the diversification point of view, yes. But how should these parents look at that particular scenario where they don't know whether the child wants to go abroad, whether they should allocate in the foreign currency, etc.? How do you look at that?
See, I would think about it like this, that if a client came to me, a parent came to me today, I would say that if your child wanted to go overseas, would you want to do that? Would you want to have the funds to be able to provide for that? Most parents, the answer may be yes, particularly if it's 10-15 years later. If it's 3-4 years later, they have an idea saying, no.
Yeah.
This kid I'm not sending at all now, it can be later, etc. So I think if you think about it that way and then say, okay, if the cost of that education is, let's say, going to be totally $100, I don't need to fund or start building a portfolio which is leading to $100 today, particularly if I have a long period of time. I can start with 10% and say my objective is to do 10% of it, 20% of it, 30% of it. It's your affordability, and because you're saying in this situation there's a long period of time, I know I can keep adding. As and when I get surpluses, I can decide in my mind that, okay, every lump sum surplus I get, I will keep 10% of it for the education or for international or 30% for it. I mean, it depends on what other goals you have.
Now, coming to the second segment, Lovai, when we talk about international equities, for most investors, it is default US market, US stock market. From the diversification point of view, do you think just investing in US markets is sufficient for that particular diversification part of international?
No, not at all. But I think the reason why people think of US first, of course, there's a lot more information available. It is yet the largest economy in the world. So by investing in US, I'm participating in a global sort of economy. So you tend to think about it, and particularly in India, because there is a good connection between the tech in India and the tech in US. There's a lot of familiarity.
And also the access, because I can access the US financial products much easier than other countries?
Yeah, I think that what happened, if I go back in history to India, that when we started maybe 15 odd years ago saying it's good idea to diversify internationally, I had a Franklin Templeton US Opportunities Fund, I had a JP Morgan China Fund. I mean, those things I started getting familiar with. So I knew there was US, and I think a couple of other, ICICI also had a US stable equity fund. The JP Morgan had an, Europe and Middle East, Africa type of fund. So and an Asia fund. So you say, okay, these are places I will get familiar with. But I don't think there were funds available which said Indonesia or Venezuela or Pakistan. There have been years in which markets like these have done phenomenally well compared to the rest of the world. And then you look back and say, oh, international investing, I should have done that. But I was saying that at that time, there were only these feeder funds.
So you started 10 to 15 years ago.
15 years ago, we started telling people it's a good idea to do this. It was after, learning financial planning and getting some exposure internationally, saying, oh, we are getting stuck with this debt equity. We should go up a couple of levels and talk about country and currency risk. Then I think we got into ETFs coming in. So you had the Nasdaq and S&P and Hang Seng being available. So you say, okay, I can do this. So I think it's a question of awareness. US, since we are talking about, should one do beyond US? I think it's important that when I'm investing in equity, I should go back to fundamentals. Equities work because companies' profits grow. If companies' profits are growing at a certain rate or expected to go at a certain rate, but the stock price is growing at many times X of that growth rate, it is a problem. Valuations are out of sync. So one needs to look at, when in deciding to invest, if I'm getting really sophisticated, then I want to know whether, so just like I said, look at country, currency, etc. When I'm looking at international, the way we look at it is, should one invest today if I had an extra dollar? Should I put in developed market or emerging market? So our preference today, as an example, in February 2026, is emerging market. Okay. And I'll come to the developed market part. So in emerging market now, what do we like? Among the larger sort of markets, we like China, and we've been saying China is a good investment last couple of years.
Because of the manufacturing.
Primarily, the valuation is very attractive. Because for almost 8-10 years, it's been a zero return till maybe 6 months or so ago. And that we saw as a good opportunity. And of course, it's not just everything in-house. We do meet a lot of fund managers and talk to them, and then we get some sense of it. So China looked good. Other emerging markets, last year, South Korea did extremely well. The year before, something else did well. So we realized that maybe we are not able to go and pick, okay, here is the other emerging market I should do. Then I should probably try and invest in an emerging market ETF. So it's global. They will reallocate between, Korea should be more, or Indonesia should be more, or some other country should be more. So I know I like those. We like those spaces. If we are looking at developed market, we like ex-US. So actually we said don't want US. We want everything else. So Europe, Japan, all these places. Look from a valuation standpoint, great. Yes, people will say, oh, Europe, there is no growth. People are old. There's nothing happening. These larger markets have cycles, and we know that the valuation is attractive. It might take a while before returns come in. But when I am investing, I have two objectives, typically. One, I want to make return. Two, I don't want to lose money. So we are suggesting non-US to avoid losing money.
At least for now.
Yeah, for now. And it doesn't mean it's zero there. Okay, US is very large component in the world market. So it cannot be zero at any point in time. But whether it is 10% or it is 50%, there is where you can play around. 50, 60, 70%, that's where you can play around. So we like the non-US. Now you say, okay, but I want to do US. Where do I do? In US, surprisingly, we actually like non-Magnificent 7. Because the valuations in the Magnificent 7 are crazy. The rest is okay. So I'd actually prefer mid cap, small cap in US rather than large cap. So then I have to pick and choose. Now I may say all of this, but you will say, no, I like the blue chips. Tell me between Tesla, Amazon, whatever, Google, where do I invest? Then one has to find something which is okay. I will get some of these well-known stocks in my portfolio, but can I hedge it with something else so that I get little diversification? I have a little hedge because all these stocks, while they have run up and they've done very well in the past, there have been times where the drawdowns have been pretty substantial. It's just that you feel comfortable with a known stock, even if it falls in value. Say, I know this stock, then nothing's happening, I'm okay. But frankly, I think in the tech space, in the US markets, drawdowns are significantly higher than what we have been used to. So single stock falls could be as high as 60, 70, 80% at some point. And in very short time, also? In very short periods of time. Okay, let's discount that 60, 70 and say 30. You will have blue chips which have fallen 30% in a very short period of time. So one has to be careful. It's a question of how much money am I putting in? What is the weightage of that in terms of total portfolio? Can I fathom this loss? So my question typically for people before I started financial planning and I started, used to ask people about investing in equity, the question was not about return they wanted to make, was how much are you willing to lose? And then the estimation was, okay, this can fall by 20%. You are willing to lose 5 rupees. Okay, then please put 25 rupees in that investment, because the worst case is you lose 5 rupees. That's again an estimate, it is projection, etc. But that's the way I think one needs to think about investing. So definitely invest beyond the US and look at variety of options.
This is interesting because, if you see how the AI is rapidly changing, it's not even like year to year, it's month to month. There is a rapid change in how the new technologies are coming in the AI space, at least. And people think there is a lot of scope in the development, and companies could actually make
absolutely. But my point is that if you think back a few months ago, the darling investment was OpenAI. Suddenly it was, oh no, it should be Google. Then Anthropic makes an announcement and everything else falls.
Yeah.
So are you going to be able to stomach that fall if your bet went wrong?
Yeah.
Is the question. And then, yes, of course, one will then say, okay, can I find an ETF which is AI oriented? Now the question of what is the composition of the ETF, who's selecting what? And how do you ensure that a company which is not today in AI but is going to suddenly overtake everybody else and be the leader tomorrow finds a place? And then you say, oh no, I did AI ETF, but that one, dark horse was not part of the ETF.
Yeah, I read Howard Marks' memo also, in which he said the same thing, similar thing, where he said, yes, it is booming and we don't know whether it will be the, best thing in the future. It could be the best technology, but whether the stocks will, benefit from that technology growing is something that we have to look for. And it could actually go up, stocks could actually go up, and stocks could actually come down very, severely. Yeah. And it's not that we completely avoid it. At the same time, it's not that we are over, investors should outweigh this particular segment. It should be somewhere balanced. Last question in this particular segment, when you're talking about emerging markets and developed markets and the emerging markets, because you have the experience, you will be able to analyze which country is particularly looking impressive in terms of valuations, and you give more weightage to that particular segment and reduce the allocation to the other segment. But being a very common investor who doesn't have so much time to understand how the valuations work, how different things work, especially in terms of stock market, what is the low maintenance allocation that they could have for the entire global equity divided between emerging markets and the developed markets?
See, if you want to consider it that way, then, you might not think of it as developed emerging. You think of it as America, Europe, Asia. South Africa.
Mm.
And then say, okay, can I get allocation there? So, we will understand China and Japan. So find something which can give you allocation to China, Japan. If you don't like Europe, drop it. If you like it, put something there.
No, say suppose I am an investor who doesn't know anything. Like I cannot gauge anything about the valuations or the stock markets.
Yeah, so
how they're
I think
performing.
then you probably go through funds or you go through broking platforms and then invest. So in a broking platform, it'll end up with the investor or the intermediary choosing which ETF or which particular stock or which industry to buy. But if I go through funds, mutual funds, and the good thing now is, and I'm sure we'll cover that later, that mutual funds have come in through Gift City outbound, which are international. So you can put in money through that route and let the fund, take the headache of figuring out is US good, Europe good, should I allocate, should I keep cash, should I invest today or tomorrow? But at least I will get my allocation to currency to start with and then to country as the next step. I think these funds which have come in now have feeder sort of funds or investment objectives of global. They are not segregating and telling you that we will only do emerging, we'll only do developed, we'll only
World
do
funds.
US, that sort
Okay.
of thing. So I
Got
do
it.
world. And let the fund manager say that, okay, right now I will reduce weightage on US or increase weightage on China or, not allocate to Europe or
Makes
do more.
sense.
That's the best way to do it.
Now, coming to the routes, which is the third segment, which is the routes on the products that one can use to invest abroad. The common thing and the most easily accessible thing for most Indian investors is the Indian mutual funds, which is helping us to invest abroad, whether it's a feeder fund or the index funds or the ETFs. Could you talk about that particular product first and the remaining routes and the options available for Indian investors so that they can make the best use of it?
Yeah, so I think there are feeder funds available in India through the mutual fund route. So many of the mutual fund companies will have tie-ups or partners who are international, and they have funds available in those countries, whether it is US or China or any other country.
Can you briefly explain what a feeder fund is?
So a feeder fund is basically me as an Indian investor is giving rupees to a fund in India, which is a Indian fund. I don't know. I don't want to take specific name, but let's say XYZ China fund.
Okay.
So I'll put money over there in rupees. I say, okay, I want to invest 25,000 rupees in that fund. What that fund is doing is it's taking the money and it's transferring the money to an overseas fund which exists in another country, in this case, let's say in China or in Hong Kong, which is investing in the Chinese markets.
Okay.
So the only job this fund is doing is just collecting the money, transferring the money into that fund. Obviously, when that money is being transferred, there is a conversion happening of the rupee into the Chinese currency. And then the money is going to get invested.
Because I'm investing in an Indian mutual fund, I don't have the headache of converting that money to.
I don't have the headache. I don't have to pay taxes in that country. Because ultimately, after whatever tax, I'll get back the money when I redeem. So
in rupees.
Yes. So let's say today I have transferred the money, I've invested this money 2 years ago. I transferred it at that time. Then 6 months later, I added some more money. So each time different conversions happened. Now I decide today that I want to redeem the money. So I will make a request for redemption to my Indian fund house. That fund house might say that, okay, this money will not come in 2 days, but it'll come in 5 days. So it might take longer. But they will in turn trigger to the feeder fund, to that international fund, that so much money is required back. That fund will look at the NAV as of that date in foreign currency, convert and sell those units, transfer the money to the Indian fund house, and that Indian fund house is going to pay me back my money. And when I get it back, whatever the differential gain I have made, I will pay taxes in India because it's international fund. I think you have to hold for 2 years before it becomes long term. Then I'll pay 12 and a half and so on and so forth. So
Got it.
that's the way it would work if I did a feeder fund. Now, unfortunately, and there are other funds which do a combination of such funds. There are funds within Indian mutual fund market which say, okay, we will do a global combination of different fund houses best funds. So we will choose the funds. So I might pick something from Nippon, something from HDFC, something from somewhere else and consolidate, and something from ICICI, and here is a fund that I'm doing. Japan I'm choosing X fund, US I'm choosing Y fund, Europe I'm choosing Z fund. And the allocation also.
Exactly.
20% here, 40% here, no, let's increase this to 25%. They are doing all of that. Now, some of these funds, unfortunately, are stopped because RBI has a limit beyond which international investing cannot happen. And they are not allowing these funds to take money in. Periodically, when I think either redemptions happen or that limit opens up, they say, okay, it's open. And then it may shut very quickly. Some will say, okay, you can do an SIP of up to 5,000 rupees in a month. Now, it's 5,000 rupees in a month, effectively in dollars is about $50 a month. Yes, you can start getting allocation, but some of those have got these restrictions. Hopefully, these will not be forever, although they look like they have stayed forever.
Yeah.
Hopefully, they will open up at some point in time, and then you'll be able to do it. So that's the simplest mutual fund route.
Yes.
The other route is if I have a demat account, then I can buy ETFs.
Demat account with the foreign broker.
No, with an Indian broker. I have the
ETFs,
Nasdaq
okay.
ETF, Nasdaq 100 ETF, S&P 500, Hang Seng, and a few other
Which
ETFs.
is again launched by the Indian mutual funds.
By the Indian mutual funds. So you are able to buy those markets through that route. So that's the other thing. Again, the same operation. I buy it, it will get converted. So I'll make or lose on the currency. Plus, I will make or lose on the market that I've invested in. So those are the first two. The sort of advanced version is I go directly to a fund. Somebody comes up with a fund which is investing globally, and I come to know about it, and then I say I can invest there.
You mean the foreign fund?
Foreign fund. Okay. So when you say foreign fund, there have been fund managers based in India whose only job has been to invest globally. So your money when you are investing now is not happening in rupee. You have to convert and do under LRS.
Okay.
Transfer the money, open the account, do the KYC for the fund, and then transfer the money into the fund, and then that fund is investing and giving you information.
Okay. And how do I, as a common investor?
Difficult. So we'll leave that aside.
Before that, can you also explain what LRS is?
Yeah, so LRS is Liberalized Remittance Scheme. Basically, the Indian resident is allowed to remit and spend in foreign currency $250,000 per year totally, including medical expense, including travel, holiday, funding child's education, all of that, but it is per individual per year.
Yeah.
That is a $250,000 limit. Now, if I have not used that for all these reasons, I can use the balance for investing. So I can transfer money overseas. So I go to my bank, fill in a A2 form, and then I transfer money.
Okay.
So based on the exchange rate on that date, the money is converted, and I have chosen the currency in which I am investing.
Sure.
Now, apart from directly getting into a fund route, I can open an account with an international broking platform. Those are available both in India. It's accessible. You could get it through intermediaries like us. You could also probably reach out and figure out if they are willing to open accounts directly.
Yeah.
And once I go into that account, these platforms have now the world available to invest. I can invest in them.
What are the other routes?
So the Gift City. Now the Gift City is basically a physical entity in India, but is deemed to be an entity which is outside of India. So the tech world will understand SEZs, where, if I'm importing something in, I don't pay duty because it's not deemed to have come in the country, because I'm going to work on that. In the earlier days, I would get a drive here, put it into my chassis box and export that computer out. Right? So it's similar to that. The investment vehicle is this Gift City. It is physically located on the outskirts of Ahmedabad. And over there, any investment that you make or any fund, so funds and fund managers need to register there. So funds and fund managers need to register in Gift City. So you could have a fund manager who is a Indian portfolio management service provider, where you and me as an Indian resident have invested in rupee, but they've set up a fund there. Why? Because they want international people, international investors to invest in that fund. Underlying for them is India. So it is reverse of whatever we've been speaking so far.
Yeah.
Similarly, there will be funds which are registered in Gift City, which will say Indian investors come and invest here because we are taking this money and we are investing it globally.
Yeah.
So now the simplest route for many investors to make international investment is through feeder funds which have come up through Gift City. So instead of my going in rupee route, now I have to, because the rupee routes, many of them are closed, I will use LRS limits and I will transfer money into that fund so that that fund in turn invests overseas.
For example, PPFAs, HDFC, DSP have come up with some funds, which is also with a minimum investment limit, which
Lower
is
limit,
accessible for most investors, right?
Yeah,
Okay,
yeah.
got it.
Then there are, like Mirai has an international fund, which is, but it's $151,000 minimum.
Okay.
So some of these are with lower limits, some are with higher limits. But also I must say that in Gift City, if you can qualify yourself as an accredited investor, those limits come down. So like the same funds which have 151,000 as minimum have $10,000 if you are an accredited investor as minimum. So again, if you have assets and if you have investments or income which is higher, then you can qualify and do that there.
So even in this case, whenever I send money to this funds in the Gift City, it is considered an LRS.
It is LRS. So basically, I'll still have to go to my bank as if I was transferring money to my child's account in the US. It's the same thing. I'll go to my bank, I'll fill in an A2 form. I will say I want to transfer to this particular fund, which could be, which is in Gift City, but transfer to this bank account which exists in for that fund to make the investment overseas.
Understand, yeah. Now, when we look at all these options that we have, which is like Indian mutual funds, even within the Indian mutual funds, there are active funds which are investing, or also, as you said, feeder funds and also the ETFs available. The second is going through an international broker. The third is the Gift City route that you have mentioned, which has a lower minimum amount to start with. And the last two, which is the international brokers and the Gift City route, which comes under the LRS, while the Indian mutual fund investing doesn't come under the LRS.
Correct.
Now, how seamless or how difficult is this LRS process for us?
It's not very difficult. So essentially what happens is each of these fund managers will have a form, which is basically your KYC. It's less cumbersome than the Indian KYC is what I can say at the moment. But you fill in those details and you send it to the fund. It takes probably 2 to 4 days to approve and say, okay, now your account is set up. This is your account number. So basically, this is your ID into which if you fund the money, we will get it. So now you go to once that is done, then you go to your bank and say, here is the details. Please remit this money. Here is the A2 form. Here's the bank details, is the account details, and this is the amount I want to transfer, and here's my declaration that it is within my overall LRS limits.
Got it.
And you transfer it. Pretty much the next day, you get a statement back saying, okay, we received $5,000, $4,000, whatever the amount that you have done, and so many units have been allotted to you. And then it's like a normal mutual fund with an NAV.
So in the LRS route, maybe the extra cost that I would incur is the forex charges and the LRS charges that I might...
Yes. So typically what happens is there is an interbank rate and then there is a spread that the bank charges. So it is never the interbank rate. So we read, let's say we will read that, oh, the rupee has now become 90 rupees 50 paisa. But if I went to transfer money out, it may be 91 plus, or, depending on your status with the bank. You might even get 92. So you'll be paying more. Similarly, if you got money in dollars or in foreign currency, you will not get 90.50. You'll get 89 something. So the bank is making that differential.
For your clients, I'm sure I think they are slightly high net worth individuals. What is the kind of route that you choose for them? Is there any cost restrictions that you would consider for a common investor when they want to invest? Do you think, is there any particular net worth, or do you say that if you're investing only like about $50,000 a year, just stick to Indian mutual funds, or else if it is more than that, go to gift funds?
No,
Nothing.
to be frank, last week I have made an investment in LRS through Gift City of $6,000. So I don't
Okay.
think there is any such restriction. So the important, yes, there are costs. There is a conversion cost, and there is a risk or a benefit that the currency, when I transferred was X, and when I get it back, let's say the rupee strengthens for whatever reason, when I withdraw it, I will lose money on the currency.
Yeah.
But my whole objective is to have an international allocation. And therefore, and with the thought process that we had, we wanted to choose a fund which was not very US heavy. Luckily, it had lower minimum amount.
And what is the forex, approximate forex charge like? How much percentage would it be?
So there are two elements. There is a charge, which is the charge that the bank has for transferring the money. So they may have a flat amount and say 1,000 rupees for every transfer. Then there is this whole GST bit which is added to that. So you will see rupees and paise getting debited to your account for that. The main charge is the currency differential between the interbank rate and the rate the bank charges you.
The spread, you said.
The spread. So it's important that you sort of soften up your relationship manager and say, I am going to do this. What is the best rate you can give me? And then before you transfer, let me know the rate. Then try and push for, okay, can you reduce it? So you'll know whether there is some scope available or not. You are going and purchasing tomatoes in the market, you will say not so much, can you reduce the rate? It's the same thing you do with this.
Got it. In the fund route, I am paying an expense ratio to the fund. If it's a feeder fund, then there will be a extra expense ratio that the underlying fund will also have.
So that all you will know in advance, that the underlying fund has 0.5% and the feeder is taking another half, so you're paying 1% or you're paying 1.5%. That will be known. You tend to look at returns which are net of all these charges, right? And I think that is important for you to consider. Not overweigh yourself on only the cost. I think the objective is little more than the cost. I think we sometimes pay too much attention to only cost.
Makes sense. Got it. Now, coming into the fourth segment, Lovai, here I want to talk about the currency risk. The first is, of course, we are going and investing abroad also because Indian rupee has been historically depreciating. Of course, there have been years where Indian rupee has appreciated, but historically the norm is Indian rupee has been depreciating. So when you're investing abroad, it will also help cover that currency risk. But the other side of the coin is when you're investing abroad, there is also a risk of the other currency, the country in which I am investing in. That currency is also falling. So how do I look at this currency risk when I'm investing in international equities?
So I think we must understand why the rupee depreciates. Primarily, inflation in India is higher than most developed markets. Therefore, interest rates in those countries are lower than in Indian markets. The simple explanation for the depreciation is that, let's say in the US currently, interest rates for 10 years, if you invest in 10 years the government bond there, it's 4.2%. In India today, it is 6.75%. Now, if there was no currency depreciation, what would people do in the US? They would borrow dollars at 4%, put the money here, get 6%, make the 2% or 2.5% or 3% differential. As a result, the currency depreciates. The currency will depreciate with the difference in the interest rate / inflation. So inflation and interest rates normally go alongside each other. So we would expect, in the past, the US used to have interest rates of 2%, India used to have 6%. So there was a 4% differential. That is typically, if you look at longer term rupee versus dollar, it's a 3 to 5% depreciation, whatever long periods you take into account. Now what has happened is it become actually 2.5%, the differential. at the current moment. So one would expect actually in the longer run that the rupee will depreciate at a lower rate than what it has been doing before. And if and when India really becomes into this stage of being very developed and therefore inflations drop, then you might find a stage where it's okay, fine, now there is no depreciation, we will remain where we are. That also could happen. Now, it is not as simple as this differential is not as simple as fixed deposit. I put it, I'm getting 6%, I will always get 6%. No. So this fluctuates.
Right.
So every day it fluctuates based on short-term trends, whether RBI is intervening or not, whether there are more flows, FPIs are putting money, withdrawing money, export is going up, import is coming down, whatever. All of that has an impact. So one has to understand that over longer period of, if I look at the next 5, 7, 10 years, rupee is expected to depreciate. It may depreciate at 2% sometimes, may depreciate at 6% suddenly, like it has happened very recently, and then find a flat period of time. So the time before the rupee actually started depreciating in the last couple of months, there was a period of almost 10 months where the rupee had not depreciated. It was like 1% depreciation. So you'd say, oh, 10 months, 1%, great.
Yeah.
But then the next 2 months, it's like 5-6%. So you will see this lumpy movement, but that's the reason why the depreciation happens. Now, the choice of whether I'm investing, so this is rupee dollar, because all currencies for India are pegged against the dollar. So you will see periods of time where, let's say, the pound or the euro has strengthened against the dollar. So the depreciation of the pound and euro is even more to the rupee, and the reverse also happens. There are times where we are weakening against dollar but strengthening against pound because the pound has weakened against the dollar. So that is what, frankly, is the depreciation is all about.
So how do we consider? So is there a thing that we have to consider about the currency risk when we are?
So when I'm making investments outside, actually I'm hoping to get a currency benefit.
Yeah.
There is no risk really. There is a plus. But as you said, because the movements are lumpy, there'll be periods of time where suddenly the rupee has started strengthening. So doing things with a short term and only looking at it from currency, I don't think one should make investment decisions based on that. But yes, if the currency suddenly weakens, like had happened
Exactly.
2 months
Then the
ago,
talks about investing abroad and saving your saving against the currency depreciation is something that keeps coming up. Right?
So I think because the currency depreciated very rapidly just before the announcement, just before the budget, right, or the day of the budget. And couple of days later, the announcement, tariff deal is probably solved, signed or is resolved, and suddenly the currency appreciated. Now, if in the few days leading up to that, you went and transferred money, lump sum outside, now suddenly you are sitting with a loss on your currency because you transferred at 93 rupees when you made your remittance, and now you will get back money at 89. So you are sitting 5% down. But again, I think if I don't do everything at one go, if I make sure that I'm not doing it only because of currency, I'm hoping that the underlying will contribute as well, and I'm doing it as a hedge, then I'm okay.
Because since there are so many moving things with respect to currency, and the ultimate objective is for diversification, we shouldn't give so much importance, or I think significant part of the intent is towards diversification and not the currency.
Yes, but at the same time, if there has been a very sharp movement one way in a short period of time, one has to be careful and say hold on to that money. So, for example, the $6,000 that I was investing, I was considering at this time, and suddenly the rupee had weakened considerably. I held it back saying, okay, it's moved too much, let's wait. And luckily the tariff thing got announced and say, okay, now let's just go ahead and do it. So little bit, but however, if you think about it, while it's strengthened by a rupee, overall it's 1% on 90 rupees, right? So you would have saved 1%. So if I'm doing $6,000, yes, $60, I recovered.
Okay.
Yeah, it's a good sum of money. I don't want to lose even if it's $1, I don't want to lose it. But I think you need to think about it from that perspective.
We are talking so much about international investing, and there could be a moment where the next 1 year, the whole international market may actually not do well, and India may do really, really well. But I think what viewers and we all should, as investors, understand is international equities is from the point of diversification. And if not now, maybe in future it may do well, but it's completely from the portfolio perspective,
Correct.
portfolio building perspective.
Yeah.
Coming to the last segment, Lovai, which is about the procedural aspects here, which is I want to focus on the tax part also. How is investing in international equities taxed? That's the first question. And then I'll get to the inheritance part, which is also very important for all of us to understand when investing in international equity.
Yeah. So I think from the international, and I'm an Indian resident, basically I am responsible for paying taxes on global income.
Yeah.
Some of the places where I would invest, if there is a withholding tax or a deduction that is made, and that country, there is a treaty with India, then I can take credit for that tax paid wherever outside.
For example, I think US dividends have a withholding tax of about 25%, 20-25%.
Yeah, so there is a withholding tax, so you'll get a credit saying so much is the tax already deducted. You can take credit for that tax when you're filing your returns here. More than tax, there's a reporting requirement that I'm holding this investment. So that is very important, because any international holding you need to report. Even if you have made it and said, okay, I'm going to hold it for 5 years and there's no payouts coming. Sometimes you tend to forget that you made that investment because you have not done any action on it, but you are supposed to report that in your Indian taxes. And then when you get the money, there are rules about how long you have held that investment. So typically the long-term holding for equities international is longer than for India. It's not 1 year, it's 2 years. Once you cross 2 years, then it's 12.5%. So,
otherwise, it's short term and tax rate, slab rate.
Yeah, it's a slab rate. Yeah.
Can you also talk about the TCS, which is the tax collected at source when we're actually sending money?
Yes. So when you're transferring money abroad, the government charges a tax collection that currently applies if your total remittance exceeds 10 lakh of rupees. Then beyond 10 lakh rupees, it's 20%. And that is like TDS, in the sense that you will have to give your PAN, etc. So it's treated as advance tax that you have paid. So if you have no other taxes or no other income, you will get this as a refund when you file your taxes in the next year.
Now, coming to the inheritance part, yes, in India, there is no inheritance tax. For a simple understanding of for all the viewers, inheritance tax that comes into picture when a person passes away and that wealth is passed on to the next generation, a certain amount will be deducted and taken by the government before it is passed on to the next generation. In India, fortunately, we don't have that. But I guess this is applicable to the US especially and other countries.
Yeah, it's applicable to US and to UK.
Okay.
So basically, if I have assets in excess of my limit in these countries, then when I pass, my estate has to pay inheritance tax. So in UK, the limit is pretty small. It's somewhere in the range of £325,000. So 3.5 crores or 4 crores and beyond. Then there is inheritance tax to be paid. In US, the tax limits are significantly higher for US persons. It's $15 million limit.
Okay.
Beyond which only inheritance tax has to be paid. But for you and me, if I am deciding that I am going to buy Amazon, Tesla, Google stock, and I am holding it in an international broking account because the underlying is US, for me, the inheritance tax limit is only $60,000. Beyond $60,000, there are slab rates for inheritance tax, starts at 18% and keeps going up. When you reach $1 million, it would be 35%. And beyond that, it is 40%. So one has to be careful about making investments in through international broking platforms where the underlying is US. So the one way out is to not buy individual stocks, but to buy index, and to buy the index in something called UCITS, which then are Luxembourg or Ireland based, which therefore don't come under US inheritance tax limits. So I get international exposure, but I am not subject to inheritance
Again,
tax.
this UCITS, can common investors like me
Yeah,
get access?
if you open an international broking platform and you invest, then you can buy Nasdaq through that, either Nasdaq US or you can buy Nasdaq through UCITS. Now the difference between the two is the expense ratio. The Nasdaq UCITS has, I think, 9 basis points when I had last seen extra expense. So you're losing 0.09% on your return, but you're avoiding inheritance tax. Other ways out would be that in that international broking platform account, make sure your account that you open is a joint account. So if one person passes, at least the second person is there, then very quickly you need to act, because the same limits will apply if your partner or whoever you opened with is an Indian resident, then the same limits apply. So you do it in that manner. So I think this issue is a big issue for people who are working in companies which are US based and they get ESOPs and RSUs. So they think, oh, I have, working in Google, Amazon, Broadcom, etc., and I have this very nice amount of ESOP and that is keeping on going up. In case of, unfortunately, one of those people passing, so we've had situations where, let's say, somebody has worked for 20 years in Broadcom, passed away. $2 million is the value of the ESOP sitting there. Now, it's not that they will deduct 40% and transfer 1.2 million to the beneficiary. They say, okay, this estate is of a person who is not US. Pay us the taxes. It's $800,000. Pay that first. Now the account will get opened. So you can't even sell those stocks to pay this.
Wow.
Which is why I was mentioning some of the people there take large insurance policies so that when they pass, the proceeds come in, they pay the estate, then all other assets are freed.
This is the life settlement funds that you're talking about.
Yeah, that's different. But I'm just saying that this is the requirement that is there, and people tend to ignore this.
Because we think that when we are investing, we might be investing small amounts, and then we don't consider the compounding effect and also the accumulation that happens over the years.
Yeah, and particularly people working in companies which have, which are US based, and you get ESOPs or RSUs and you keep accumulating them, saying, oh, they're continuously going up. And you don't sell them, you're worrying about your 20-30% tax. You are not taking into account 40% inheritance. So you'll actually save all of that if you did some planning around it.
Got it. Thank you so much, Lovai. I think it's an information-packed video. Thanks for giving us so many details. Viewers, I hope you find this video very informative. If you have any questions, please leave in the comments and we'll try to answer as many questions as we can. Thank you so much.
I would add one more small thing. I think that people watching this, if they are faced situations, and they can share those situations, because a lot of our learning and knowledge comes from situations. You know the base, but okay, in this situation, what do you do? How do you deal with it? Is always
absolutely
challenging and a learning experience, and then it benefits everybody else.
Exactly. That's a very good point. So please share your experiences and situations as well in the comments, so that it will help others as well as us learning, educating other people. Thank you so much, Lovai.
Thank you.